Hello again, everyone, and welcome to the Options Mentor. That was a tumultuous week. Fortunately for me, I was flat after Wednesday and didn't go through the Thursday and Friday ruckus that the market had. The Thursday was absolutely insane with the whipsawing around. So I'm going to get back into market. I would assume tomorrow. I was out a couple days there for deer hunting. So I guess this year it actually helped me out. Not only did I get a deer, but I also avoided one of the bigger whipsaws I've seen in a while that we had on Thursday, which can be very tough to do in a non-directional trade, which once again, as I tell you guys every week, just shows how much you need width and how much of it you do need. All right, so let's start out here and look at the charts real quick, and I'll show my Thinkorswim. And we have the VIX way spiked up, hasn't really been here since it was in no October, and then before that, all the way back in May, April area. So the VIX normally reverts to the mean. So the natural thing here to happen would be for the volatility to come down lower. There's a better chance of that at least than it would be to go higher. So we still probably would be best to be in trades that are very neutral or maybe even short volatility with what we're doing. And you can kind of see why all this is going on over here by looking at the VIX charts. And once again, look at that Thursday candle. It just amazes me. That was a crazy one. So this week, once again, we'll have to revisit that double butterfly that we looked at last week. I think that really that's your best choice in this environment. Not only is it short Vega, it's not a lot. If you just do a one contract here, two one contract flies, your Vega's short 84. That means if volatility works for you and goes down a point in your favor, you make $84 in your, well, show in your P&L. And if it goes against you, you would lose that. But very little overall what it will do for you, but you will be a little short. And I think that's the place to be since chances are volatility could go lower. We're headed into Thanksgiving week, which often can be a lower volume, sometimes, many times, traditionally, I should say, would be more peaceful. But we can't always count on that anymore. And we do have the PPI on Tuesday, but perhaps after that, things will slow down a bit. Of course, we're closed for Thanksgiving here in the U.S. on Thursday, and Friday is an early closing. We opened at the normal time and we closed at 1 Eastern, I believe it is. So that'll be very abbreviated. Usually that's a very low volume day unless something really important happens, over that Wednesday, Thursday time period. So this traditionally has been a great week to collect time decay, hopefully very little movement. With this market, I don't quite trust it. So I'm very happy to put on a trade like the one I'm showing you here, which once again is based on Friday's close, which was 66.02 in the SPX. And what I did from there to set up this fly is I went about 70 points higher to 65 or 66.70. And I centered a call fly that I made 80 points, 80 points up, 90 points down. So it's an asymmetrical call fly. Looks like this if the other one isn't on there with it. The short is closer to one long than it is the other. Asymmetrical flies generally give a little smoother line, the daily line. Things go for and against you a little slower, which I actually like in a non-directional trade. Now on the put side, I went down 70 to 65.30 and then up 80, down 90 with the wings once again. And you put those two together and you have look at this, a 300 point range between the expiration break evens. Now, lately you're going to need most, if not all of that. But I mean, this truly would mean we could take 150 points up, and you would have to do nothing or just very close to nothing. Maybe not quite 100, 120, 130. Same thing on the downside. So you have lots of room, which I like. Now with this trade, it would cost 1565. It's showing here if you got filled at the mid for the call fly. Now the put butterfly, you see a lower debit 380. Now don't forget, that's because brokerages have decided asymmetrical put flies are they margin them like a debit and a credit verticals, two of them together. So you have 990 in margin plus 380. So this trade really costs a little over 1,300 bucks. So it's very similar to the call fly, but the call fly has it all in the debit. Either way, you need to account for all that. So this trade here would cost about $2,900, 1,565, a little over 1,300, maybe even 3,000 right in that area. So if I got up about $250 my P&L, I'd be looking to get out. And the way I would close that, of course, is to put in an order at the mid price to sell this and this. Don't try to time it. Try to get them both off at a very similar time. Because if you try to time it, that just means you're hoping, right? Well, I'm up here, I'm going to sell the call fly while it's worth more, and then it'll go back down and I'll sell the put fly. Well, we all know that kind of thing can lead to disaster. So try to put the orders in at the mid for both of them and then work your way out. Now, usually the one you're closer to will fill a little bit easier. Let's say we were up in here, that call fly would probably fill easier than the put fly. Or if we were down in here, the put fly would fill easier than the call fly. So just keep that in mind. But try to get that 250, maybe even $300 profit, and then put the order in case you do have some slippage, where maybe you did get one side off quickly and the other side you're having to give in a little bit. But that's just how these flies are traded. Double complex like this that you can't put on and off. All is one trade. We do have to do it. It's two separate trades, so we have to try to get out of it pretty quickly on each side. Would be great if we could do this as a double, but so far most brokerages anyway don't want you to do more than a 4-leg trade. So that's what I have for you guys this week, unless something changes. By Monday morning things could change. Who knows? Maybe there'll be great news. We're up a lot, and the VIX is down closer to 20. You might do a double diagonal. If we're down around 20 or lower, you could certainly still do this though. But if we're here or we're up higher, up to about 30 on the VIX, I think this would be the trade. When you get above 30, I really mostly stand aside, except for speculative trades, because it's very tough to trade a VIX of over 30 for very long with non-directional trades. You can get away with it at times, but you're probably better off to do other trades, maybe some speculative stuff while you're biding your time for the market to calm down a bit. As always, hit that like and subscribe button. Don't forget to comment on the video if you have any questions or comments, and check out all the links in my description to join me every day. All right, folks, have a great Thanksgiving week, and I will be back with you next week to look and see where we're at by then. Who knows what will happen this week? So have a good one. Bye-bye.